What if everything you were ever told about money was designed not to help you, but to keep you just comfortable enough to never ask the right questions? Not conspiracy theory comfortable, not tinfoil hat comfortable, just paycheck to paycheck, trust the system, hope for the best, maybe it all works out comfortable. Sound familiar? Most people spend 40 years working hard, saving a little, trusting the wrong people, paying fees they didn't know existed, and walking straight toward a retirement that was never actually prepared for them. And the brutal part? None of it was an accident. That's exactly why today's video exists. You've been playing a financial game your entire life without anyone ever showing you the actual rulebook. And once you understand what's really happening with your money, your retirement, your so-called financial advisor, you can't unsee it. That's the promise of Money Master the Game by Tony Robbins. And that's what this entire summary is built around. We're going to walk through how hidden fees silently steal your future, why the retirement crisis is more personal than you think, how asset allocation beats stock picking every single time, what the truly wealthy do completely differently, why losing money is more dangerous than you ever realized, who you can actually trust with your financial life, and what the billionaires told Tony Robbins when the cameras stopped rolling. This isn't a lecture. This is the conversation nobody had with you when it actually mattered. So let's get started. Chapter 1. The Hidden Fees and Half-Truths of Wall Street. Let me ask you something real quick. And I need you to be honest with yourself, not Facebook profile honest, actually honest. How much do you actually know about where your money goes? Not where you think it goes, where it actually goes. Because most people, smart people, hardworking people, people with degrees framed on their walls, have absolutely no idea. And that's not an accident. That's a design feature. Here's the thing about Wall Street that nobody puts in the brochure. It is not built to make you rich. It is built to make them rich, while making you feel like you're the one winning. It's like a casino that serves you free drinks, plays feel-good music, and calls the security guard a financial advisor. You're having a great time. You're losing money. But the ambiance is lovely. Tony Robbins spent years interviewing the greatest financial minds on the planet. Nobel Prize winners, billionaires, people whose net worth has more zeros than your Wi-Fi password, has characters. And the one thing almost every single one of them agreed on? The average American investor is getting absolutely taken apart by fees they don't even know they're paying. Fees. That word sounds so innocent, doesn't it? So harmless. Like a little fee. A teeny tiny fee. What's a fee gonna do? Oh, buddy. Pull up a chair. Let's say you invest $100,000 over 30 years. Market returns about 7% a year on average. If you're in a low-cost index fund charging 0.1% in fees, you end up with around $760,000. You're out here living your best life, buying the good paper towels, not the generic ones that fall apart when you sneeze near them. But if your fund is charging 2% in fees, which is completely normal in actively managed mutual funds, you end up with around $432,000. Same market, same 30 years, same you. You just handed $328,000 to someone else. For what exactly? For someone in a nicer suit than you to make decisions that, statistically, worse than just leaving it alone. That's not a fee. That's a second mortgage on your retirement. And the brutal part? Most people don't even know the fees exist. They're buried in something called the expense ratio, which sounds like a term from a NASA launch report, not something that's quietly eating your future. The financial industry has spent an enormous amount of money making sure you don't go looking for it. And honestly, they've done a great job. Standing ovation, truly elite-level misdirection. Now let's talk about the guy selling you the fund, the financial advisor. And look, some of these people are genuinely trying to help you, some of them. But here's the thing you need to understand about how this industry works. Most financial advisors are not legally required to act in your best interest. Read that again. They are legally allowed to recommend products that are good for them, as long as those products are suitable for you. Suitable. Like a pair of shoes that technically fits, but gives you blisters every single day. Technically suitable. Absolutely terrible. The word you're looking for, the word that actually means they have to put your interest first, is fiduciary. That's the gold standard. That's the person who, by law, has to give you advice that benefits you and not their quarterly commission check. And most advisors, not fiduciaries. Most brokers, definitely not fiduciaries. But they use the same words, the same handshakes, the same mahogany desk energy, and people trust them completely. This is why Tony Robbins says, and I'm paraphrasing here, that the game is rigged, not in a tinfoil hat way, in a very boring, very legal, very well-documented way. The system was built by people who benefit from your confusion. So naturally, they like keeping you confused. Now here's where it gets really interesting. Every year, fund managers, the people being paid handsomely to pick stocks, go up against simple index funds that just track the market. No genius, no strategy, no guy in a corner office with a Bloomberg terminal and a God complex, just the market. And year after year, over 80% of actively managed funds underperform the index. Over 20 years, it's closer to 95%. 95%. Let that sit. You are paying more money for someone to do worse than a robot that just copies the S&P 500. That's like hiring a personal chef who charges triple, takes 3 hours, and makes food that's somehow worse than the frozen meal you could have microwaved yourself. But hey, he wears the toque. Very professional. So what do you do with all of this? First, you wake up. That's step one. You stop assuming that because someone has a fancy title and a firm handshake, they are working for you. Start asking questions. What are my total fees? Are you a fiduciary? How do you get paid? Watch their eyes when you ask that last one. Very educational. Second, you start paying attention to low-cost index funds, Vanguard, Fidelity, Schwab, the boring names, the ones without the commercials with dramatic music and helicopter shots of Manhattan. Those boring names are quietly making regular people wealthy in ways that complex high-fee funds simply aren't. And here's the thing. This isn't about being cynical about the system. It's about understanding how the game actually works so you can stop being the player who doesn't know the rules. Because right now, somewhere in your retirement account, in your 401k, in some fund somebody put you in years ago that you've never really looked at, fees are running. Right now, as you listen to this, the meter is going. The question is, how long are you going to let it run before you do something about it? That question, hold on to it, because we're just getting started. Chapter 2. Winter is coming. But when? Nobody wants to think about getting old. I mean, we'll spend 45 minutes picking the right Netflix show, but ask someone to spend 45 minutes thinking about their retirement plan, and suddenly they've got laundry to do, a text to return, and a very urgent craving for Chipotle. We will do anything, literally anything, to avoid looking at the numbers. And honestly, part of me gets it. Because when you do look at the numbers, they're terrifying. Not horror movie terrifying where you can laugh it off after. More like, read your bank statement at 2 a.m. terrifying. The kind of scared that just quietly sits in your chest. Here's the reality that Tony Robbins lays out, plain and uncomfortably clear. America is walking straight into a retirement crisis, not tiptoeing, not stumbling, walking, with confidence, like someone who has no idea the bridge is out ahead. Let's start with pensions. Remember those? Your grandfather had one. He worked 30 years for the same company. They handed him a gold watch and a guaranteed monthly check until he died. Beautiful system, stable, predictable. Also, almost completely extinct now. Corporate America looked at pension obligations somewhere around the 1980s and said, you know what? This is expensive and we'd really rather not. And just like that, the responsibility shifted from the company to you. They handed you a 401k, patted you on the back, and said, good luck, buddy. Hope you figure out investing because we sure aren't going to teach you. And most people didn't figure it out. Most people just contributed whatever the default was, never looked at it again, and hoped for the best, which is a financial strategy in the same way that leaving your car windows open and hoping it doesn't rain is a weather strategy. Now let's talk about Social Security. And I say this with respect. Social Security is not a retirement plan. It was never supposed to be a retirement plan. It was designed as a safety net, a floor, not a penthouse. The average Social Security benefit right now is somewhere around $1,500 a month. In most American cities, that doesn't even cover rent, let alone food, medicine, utilities, or the increasingly expensive hobby of just existing as a human being in this country. And here's the part that really stings. The Social Security Trust Fund, the pool of money that's supposed to keep those checks coming, is projected to run low within the next decade or so. Nobody in Washington loves talking about this at dinner. But the math doesn't care about anyone's comfort level. The math just keeps doing math. So we've lost pensions. We can't retire on Social Security alone. The 401k was dropped in our lap with basically zero instruction. And here's the final twist, the one nobody saw coming 60 years ago. We're living longer. Which sounds like great news. And in many ways it is. Medical science is out here doing things that would have seemed like science fiction a generation ago. People are living into their 80s, 90s. Some researchers are genuinely talking about a future where 100 is the new 70. But financially, living longer is expensive. Every additional year of life is another year of groceries, rent, healthcare, prescriptions, and all the other relentless costs of being alive. Tony Robbins calls this longevity risk, and it's one of the most underestimated threats to retirement security in America today. You could save responsibly your whole life, retire at 65 with what feels like enough, and then live 25 more years. 25 years is a long time to make a fixed pile of money last. And healthcare costs in those later years. Don't even get me started. Actually, let's get started because you need to hear this. The average American couple retiring today is expected to need somewhere around $300,000 just for healthcare costs in retirement. Just healthcare, not housing, not food, not that cruise you've been promising yourself since 1987, just the cost of keeping your body operational, $300,000. For context, most Americans retire with far, far less than that saved in total. This is the winter Tony is warning about, not a dramatic sudden collapse, a slow, cold arithmetic reality that sneaks up on people who kept saying they'd deal with it later. Later became eventually became almost. And almost is a very uncomfortable place to be when you're 68 and the savings account isn't what you thought it was. The median retirement savings for Americans approaching retirement, people in their 50s and 60s, is somewhere around $120,000, which sounds like money until you do the math and realize it runs out in about 4 years if you're drawing it down to live on. And then what? Then you become financially dependent on family, on government programs, on circumstances you never planned for and never wanted. And the cruelest part is, none of these people are lazy. None of them are stupid. They worked hard. They played by the rules as they understood them. They just never had anyone sit them down and say, hey, the rules changed. Here's what's actually happening, and here's what you actually need to do. That's what this is. Not a lecture, not a guilt trip. Just someone finally telling you the truth before the storm hits instead of after. Winter is coming. That part isn't negotiable. The only question, the one that actually matters, is whether you'll be standing outside in a t-shirt when it arrives, or whether you'll have built yourself a warm enough house to ride it out. That choice? Still yours to make. But the window doesn't stay open forever. Chapter 3. Asset Allocation. The key decision that determines your financial destiny. If someone asked you right now, hey, what's your asset allocation? What would you say? Most people would say something like, my what? And then slowly back away from the conversation like they just accidentally made eye contact with a street preacher outside a Walgreens. And that's fine. That's where most of us start. But here's the thing. That one question, that one decision, is arguably the single most important financial choice you will ever make. More important than which stocks you pick. More important than whether you bought Bitcoin in 2015 and then forgot your password like an absolute legend. More important than all the hot tips your brother-in-law has been texting you since 2019. Asset allocation. That's the game within the game. And Tony Robbins is very clear about this. He didn't make it up. The research did. A landmark study in 1986 looked at what actually drives investment returns over time. And the finding was staggering. More than 90% of your results, 90%, come not from which individual investments you pick, but from how you divide your money across different types of assets: stocks, bonds, real estate, cash, alternatives, the mix, the proportion, the balance. The stock picker obsessing over earnings reports at midnight is optimizing the 10%. The person quietly getting their allocation right is winning the 90%. And Wall Street would very much prefer you stay focused on the 10%, because that's where they sell you the most stuff. So let's break this down in plain English. Assets come in basically two buckets. Robbins calls them your security bucket and your risk bucket. Think of it this way. Your security bucket is your financial bunker. This is where you put money you absolutely cannot afford to lose. Bonds, treasury securities, fixed annuities, cash, stuff that doesn't make you rich overnight, but also doesn't give you a panic attack when the market drops 400 points on a Tuesday for no apparent reason. Your risk bucket is where growth lives: stocks, real estate, high-yield investments, emerging markets. This is the bucket that can double your money. And yes, the same bucket that can also light a portion of it on fire during a bad year. Higher risk. Higher potential reward. The key word being potential. Now here's where most everyday investors go wrong. They either put everything in the risk bucket because someone told them they needed aggressive growth, and then they lose 30% in a downturn and panic sell at exactly the wrong moment. Or they put everything in the security bucket because they're terrified of losing anything. And then inflation quietly eats their purchasing power alive over 20 years while they feel totally safe. Both of those outcomes are bad, just in different flavors. The genius of proper asset allocation is that you're not picking one bucket. You're engineering a relationship between both buckets and a third one. Robbins calls the dream bucket, which is the fun money, the stuff that makes life worth working for. So that when one part of your portfolio gets hit, another part cushions the blow. When stocks drop, bonds often hold. When inflation rises, real estate and commodities sometimes shine. The whole thing is designed to move in ways that don't all collapse in the same direction at the same time. This is called diversification. And yes, you've heard that word before. You've heard it so many times it's lost all meaning, like the word synergy in a corporate meeting. But real diversification isn't just owning 12 different stocks. That's not diversification. That's just owning a smaller version of the same risk. Real diversification means spreading across asset classes that behave differently from each other, that don't all sneeze at the same time when the market catches a cold. Here's the part that blew my mind when I first really understood it. The biggest institutional investors in the world, endowments, sovereign wealth funds, pension funds managing money for millions of people, they don't invest like the mutual fund your HR department defaulted you into. They have allocations to private equity, hedge funds, commodities, real assets, international markets. They have complexity and diversity that the average retail investor never sees because it was never offered to them. And the result? Institutions like the Yale Endowment, managed by the legendary David Swensen, have produced returns that crush the average retail investor's portfolio over decades. Not because they're smarter about picking individual winners, because their allocation architecture is completely different. Swensen himself, by the way, basically told regular investors, stop trying to pick stocks, stop paying for active management, and get your allocation right. This is a guy managing billions of dollars telling you the secret is not complicated. It's just different from what you've been sold. Now your allocation isn't going to look exactly like Yale's. You don't have the same access, the same timeline, the same resources. But the principle, the underlying truth, absolutely applies to you. Getting the ratio right between security and growth, between domestic and international, between stocks and real assets, that decision matters more than anything else you will do with your investment portfolio. And the right allocation isn't the same for everyone. It shifts with your age, your income, your risk tolerance, your timeline. A 24-year-old with no dependents and 40 years of runway should be allocated completely differently than a 58-year-old with 2 kids in college and retirement 8 years away. One size fits nobody in this game. The question you should be sitting with right now isn't, which stock should I buy? It's, how is my money divided? And does that division actually match where I am in life and where I need to go? Because if you don't answer that question intentionally, the market will answer it for you. And the market doesn't care about your timeline. Chapter 4. The Core. 4 principles that can help you win the game. All right, let's say you've woken up. You know about the fees. You've felt the cold wind of the retirement crisis on the back of your neck. You understand that allocation matters more than stock picking. Good. That's real progress. Most people never get even that far. But now what? Because understanding a problem and actually knowing what to do about it, those are 2 completely different things. That gap right there, between knowing and doing, is where most people's financial lives quietly fall apart. They read the book, they listen to the podcast, they feel genuinely motivated for about 11 days. And then life happens. Netflix drops a new season of something, the kids need something, work gets crazy, and suddenly it's 6 months later and nothing has changed except the fees kept running. So Tony Robbins goes deeper. He gives you 4 core principles, 4 rules, that the wealthiest, most sophisticated investors on the planet actually live by. Not theories, not maybe someday ideas. Actual operating principles that protect money, grow money, and keep you in the game long enough for compounding to do its quiet, miraculous work. Let's go through them, one by one. The first principle is, don't lose money. And before you say, well, obviously, hear me out. Because this sounds like the most basic thing in the world until you realize almost nobody actually treats it as a rule. Most people treat losses as just part of the deal. Stuff happens. Markets go up, markets go down, you lose some, you win some. Very zen, very expensive. But here's the math that changes everything. If you lose 50% of your investment, and during 2008, a lot of people did, you don't need a 50% gain to get back to where you started. You need a 100% gain. Double. Because you're now working from a smaller base. Lose half of 100,000 and you've got 50,000. You now need that 50,000 to become 100,000 again. That's not a recovery. That's starting over. This is why the world's greatest investors are obsessed, almost irrationally obsessed, with not losing. Warren Buffett's 2 famous rules of investing are rule number 1, don't lose money, and rule number 2, don't forget rule number 1. People laugh when they hear that. It sounds like a joke. It is not a joke. It is the entire philosophy. Protecting the downside isn't pessimism. It's math. The second principle is seek asymmetric risk and reward, which sounds like something a hedge fund manager says to sound impressive at dinner. But the actual concept is simple and genuinely powerful. Asymmetric return means you structure your investments so that if you're wrong, your loss is small and defined. But if you're right, your gain is large and uncapped. You're not betting even money. You're engineering the odds. You're looking for the trade where you might lose $1, but you could make 5 or 10. Tony gives a perfect example of this. His mentor, Paul Tudor Jones, one of the greatest traders alive, refuses to enter any trade unless the potential upside is at least 5 times the potential downside, 5 to 1. That's the filter. And because of that filter, Jones can be wrong more than he's right and still make extraordinary money. Because when he wins big. When he loses small. That asymmetry changes everything. And you can apply this principle without being a hedge fund trader. It shows up in how you structure your portfolio, how you approach real estate, how you think about any investment opportunity. Always ask, what's the most I can lose versus the most I can gain? If those numbers don't make sense together, walk away. Third principle, tax efficiency. Oh yeah, we're talking taxes. I know, everybody's favorite topic, right up there with dental appointments and checking your credit score. But listen, taxes are one of the biggest and most controllable drains on your wealth. And the word controllable is doing a lot of work in that sentence. The difference between a taxable account and a tax-advantaged account, your Roth IRA, your 401k, your HSA, can be hundreds of thousands of dollars over a lifetime. Not because the investments are different, because the tax treatment is different. Compound growth that never gets interrupted by a tax bill every year is a fundamentally different animal than compound growth that gets trimmed annually. The wealthy understand this deeply. They have accountants, they have tax attorneys, they structure their holdings specifically to minimize what gets handed to the government legally and strategically. You don't need a team of professionals to start thinking this way. You just need to stop leaving tax-advantaged space on the table because nobody ever explained why it matters. And the fourth principle, diversification. We touched on it in the last chapter, but Robbins here takes it further. True diversification means spreading across asset classes, across geographies, across time. It means not having all your eggs in American stocks, not having all your eggs in your company's 401k options, not having all your eggs anywhere, really. Because when one basket drops, and eventually one basket always drops, you need other baskets that didn't. Here's the beautiful thing about these 4 principles. They work together. They reinforce each other. Avoiding losses protects your base. Asymmetric bets protect your upside. Tax efficiency accelerates your compounding. Diversification protects you from the catastrophe you didn't see coming. Together, they're not a strategy for getting rich quick. They're a strategy for not getting poor slowly. Which, if you look around at how most people's financial lives actually unfold, turns out to be incredibly rare and incredibly powerful. The game isn't about making one brilliant move. It's about not making the moves that knock you out of the game entirely. Stay in the game long enough with these 4 principles quietly working in the background, and time itself becomes your greatest asset. Chapter 5. Recreate the portfolio of the ultra-wealthy. Let me paint you a picture. 2 people, same city, same year, same stock market. One of them ends the decade significantly wealthier than when they started. The other one ends the decade roughly where they began. Maybe a little ahead, maybe a little behind, depending on which 2 years you pick. Same economy, completely different outcomes. What's the difference? It's not intelligence, it's not luck. It's not who had the better broker or the hotter stock tip or the cousin who works at a tech company and whispered something useful at Thanksgiving. It's architecture. The way the wealthy build their portfolios is structurally different from the way everyday Americans are taught to invest. And the gap between those 2 structures, that gap is where decades of wealth either get created or quietly disappear. Tony Robbins spent time with some of the greatest investors alive to understand exactly how they think about building a portfolio. And what he found wasn't some secret algorithm or insider access that only billionaires can touch. It was a philosophy, a framework, one that, with some adaptation, any regular person can start applying to their own financial life. Let's start with Ray Dalio, because if there's one portfolio in this entire book that made people stop and genuinely reconsider everything they thought they knew about investing, it's his. Ray Dalio is the founder of Bridgewater Associates, the largest hedge fund in the world. This man has forgotten more about markets than most people will ever learn, and his core insight, the one that changed how Robbins thinks about investing, is this. There are only 4 things that move asset prices: economic growth going up, economic growth going down, inflation going up, inflation going down. That's it. 4 seasons, 4 economic environments, and most people's portfolios, the standard 60% stocks, 40% bonds split that everyone recommends, are actually not balanced across those 4 seasons at all. They're heavily weighted toward one scenario: economic growth. If the economy is growing and inflation is tame, that portfolio does great. But the moment you hit a different season, stagflation, deflation, recession, that same portfolio can get absolutely hammered. And it has, multiple times in living memory. Dalio's answer to this is what he calls the all-weather portfolio, a portfolio designed to hold up reasonably well in all 4 economic seasons, not to maximize gains in any one environment, but to survive and grow across all of them. The specific breakdown Robbins shares looks something like this: 30% in stocks, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in gold, 7.5% in commodities. Now I know what you're thinking. That seems like a lot of bonds. That seems boring. Where's the excitement? Where's the Tesla? Where's the GameStop energy? And yeah, it's not exciting. It's not supposed to be exciting. Exciting in investing is usually code for please watch me lose money in new and creative ways. When Robbins backtested this portfolio over decades, going back to 1984, the results were remarkable. The all-weather portfolio was profitable in 86% of the years tested. The average loss in the bad years was just under 2%. The average annual return was just under 10%, with dramatically less volatility than a standard stock-heavy portfolio. Less drama, similar returns, fewer years of watching your retirement account look like a horror movie. That's the whole point. Now let's talk about what else the ultra-wealthy do differently, because it goes beyond just portfolio construction. The truly wealthy have access to what Robbins calls alternative investments, private equity, hedge funds, real assets like timber, farmland, infrastructure, investments that don't move in lockstep with the public stock market, investments that provide what the financial world calls low correlation, meaning when stocks are collapsing, these assets aren't necessarily collapsing with them. For decades, this world was completely closed to regular investors. You needed to be an accredited investor, which basically meant you needed to already be wealthy to access the investments that make people wealthy. The system is not subtle about its preferences, but the landscape is shifting. Index funds democratized stock market investing. New platforms are slowly democratizing access to alternatives. Real estate investment trusts, REITs, let everyday investors own a slice of commercial real estate without buying a building. Certain funds now offer exposure to private equity strategies at lower minimums than ever before. The wall isn't completely gone, but there are more doors in it than there used to be. The mindset shift Robbins is pushing here is this: stop thinking like a retail investor. Start thinking like an institution. Institutions don't just buy index funds in hope. They engineer portfolios. They think in decades. They protect the downside obsessively. They diversify into assets most people don't even know exist. You don't need Dalio's billions to adopt Dalio's thinking. You don't need a family office to start building like the wealthy build. You need the framework. You need the philosophy. And you need the discipline to actually apply it, which, let's be honest, is the part most people skip because discipline requires saying no to things. And we live in a one-click purchase, instant gratification, add-to-cart society that has made saying no feel practically unconstitutional. But here's the quiet truth sitting underneath all of this. The wealthy aren't smarter than you. They're not harder working than you. They just learned a different set of rules earlier. And then they played by those rules consistently. The rules are available to you right now. The only question is whether you're ready to actually use them. Chapter 6. Never lose money. There's a moment. Most investors have had it. You probably know exactly what I'm talking about. You check your portfolio on a random Tuesday. Maybe you're sitting in your car in a parking lot. Maybe you're waiting for your coffee order at Starbucks. And the number on the screen is just wrong. Not wrong like a rounding error. Wrong like, who decided to set this on fire while I wasn't looking? And your stomach just drops. That feeling, that specific, nauseating, completely personal feeling of watching money you worked for, hours you traded your life for, just evaporate on a screen. That's not abstract. That's real. And if you've felt it, you already understand at a gut level why the principle Tony Robbins hammers on in this section of the book is not just financial advice, it's survival. Never lose money. Now, we touched on this in the Core 4 chapter. But Robbins goes much deeper here. Because this isn't just a cute Warren Buffett quote to put on a motivational poster between a sunrise photo and a generic caption about hustle. This is a mathematical reality that reshapes how you have to think about risk entirely. Here's the thing about losses that makes them uniquely destructive. They are not symmetrical. Gains and losses do not cancel each other out the way your brain naturally assumes they do. If your portfolio drops 20%, you need a 25% gain just to get back to zero. Drop 30%, you need 43% to recover. Drop 50%, you need a full 100% gain. You need to double your money just to be back where you started. So you're not just losing money when you take a big hit, you're losing time. You're losing the compounding that would have happened on that money during the recovery period. You're losing years. And depending on where you are in your financial life, you may not have years to spare. This is the hidden violence of a bad loss. It doesn't just hurt you today, it reaches forward into your future and quietly rearranges everything. Tony shares a story in the book that illustrates this perfectly. Two investors. Both start with the same amount of money. One experiences strong gains early in retirement, then some losses later. The other experiences losses early, then strong gains later. Same average return over the same time period. Completely different outcomes. The one who took early losses, even with the same average return, ends up with dramatically less money, because the losses happened when the base was largest, when the compounding engine was supposed to be running at full speed. Sequence of returns risk, that's what it's called. And it's the reason why the decade right before and right after you retire is the most financially dangerous decade of your life. A major market crash at the wrong moment can permanently alter what the rest of your life looks like. Not temporarily, permanently. So how do you protect against it? A few ways, and none of them require you to predict the market, because nobody can predict the market, and anyone who tells you otherwise is either lying or selling something. Probably both. The first protection is that allocation we talked about. A genuinely diversified portfolio, spread across asset classes that don't all collapse together, naturally limits how much any single event can damage your total picture. You can't stop a storm, but you can build a house that doesn't collapse in one. The second protection is what Robbins calls the bucket strategy in retirement. You keep a portion of your money, maybe 1 to 2 years of living expenses, in safe, liquid assets, cash, short-term bonds, something you can live on without touching your investment portfolio. So when the market drops 40%, and at some point it will drop significantly, you don't have to sell anything. You just live from the safe bucket while you wait for the market to recover, which historically it always has. You're not panicking, you're not selling at the bottom, you're just waiting. With coffee, like a financially disciplined adult. It's incredibly boring. It's incredibly effective. The third protection is downside hedging. Option strategies, certain types of annuities that guarantee income floors, structured products that cap your upside but protect your downside. These aren't for everyone. They have costs and complexity. But for people approaching or in retirement, having a guaranteed income floor, money that shows up no matter what the market does, changes the psychological game entirely. You stop making fear-based decisions because you're no longer financially terrified of a bad month. And that matters more than people realize. Because the single most expensive thing most investors do isn't paying high fees. It isn't picking bad stocks. It's making emotional decisions at the worst possible moments. Selling when the market is down, sitting in cash when the market recovers, chasing performance after it's already happened, all driven by one thing: fear. Remove the fear. Remove the desperation. Give yourself a financial floor you can stand on. And suddenly you make better decisions, calmer decisions, longer-term decisions. The math of never losing money isn't just about protecting what you have. It's about protecting who you become as an investor when the pressure is on. Because that person, the calm one, the patient one, the one who doesn't panic sell at the exact wrong moment, that person builds wealth. The other one just rides the emotional roller coaster. And roller coasters, last time I checked, always end up back where they started. Chapter 7. Who can you really trust? Imagine you walk into a doctor's office. You're not feeling great. Maybe it's nothing. Maybe it's something. You don't know. That's why you're there. The doctor runs some tests, looks at the results, and then recommends a treatment. A specific medication. From a specific pharmaceutical company. You trust him. Of course you trust him. He went to medical school. He has a white coat. There are framed diplomas on the wall, and everything smells vaguely of antiseptic, which somehow makes it feel more official. What you don't know, what nobody tells you, is that this particular doctor gets a very nice referral bonus every time he prescribes that particular medication. The treatment might be fine. It might even be good. But is it the best option for you specifically? Or is it the most profitable option for him? Now replace the doctor with your financial advisor. Replace the medication with a mutual fund. Replace the referral bonus with a sales commission. Same story, different industry, same problem. This is the trust crisis at the heart of American personal finance, and Tony Robbins tackles it head-on in a way that makes you realize the confusion most people feel about money isn't accidental. It's architectural. It was built into the system deliberately, because a confused investor is a profitable investor. Let's get clear on something fundamental right now. There are two types of people who can give you financial advice in this country, and the difference between them is not obvious from the outside. They often have similar titles, similar offices, similar firm handshakes, and business cards. But the difference on the inside is enormous. The first type is a broker. A broker is legally required to recommend investments that are suitable for you. That word again. Suitable, technically appropriate, like a participation trophy, technically valid, not actually optimal. A broker can legally steer you toward a higher fee product that benefits them more as long as they can argue it was suitable for your situation. And they're very good at making that argument. They've had a lot of practice. The second type is a fiduciary. A fiduciary is legally required to act in your best interest, period. Full stop. Not their best interest, not their firm's best interest. Yours. If they recommend something and later it comes out that a better option existed that they didn't tell you about, they have a legal and ethical problem. The bar is fundamentally different. Same title on the business card sometimes. Completely different legal obligation. And here's the kicker. Most people have no idea which one they're sitting across from. Most people assume, reasonably but incorrectly, that anyone calling themselves a financial advisor is legally obligated to help them. They're not. Caveat emptor doesn't begin to cover it. So how do you tell the difference, you ask? Directly. Are you a fiduciary? Are you legally required to act in my best interest at all times? And then you watch what happens. A real fiduciary will say yes without hesitation and can put it in writing. Someone who isn't will get very suddenly interested in changing the subject. They'll use words like, "We always strive to act in our client's best interest," which sounds great and means absolutely nothing legally. Words matter. Legal obligations matter more. Now here's where it gets even messier. Even among fiduciaries, even among the good ones genuinely trying to help you, There are incentive structures that can subtly warp their recommendations. Does the advisor get paid more when you buy certain products? Does their firm have proprietary funds they're incentivized to push? Are they fee-only, meaning they only get paid by you directly, or fee-based, meaning they get paid by you and earn commissions from products? Fee-only fiduciaries are the gold standard. They have one master, you. Their income goes up when your portfolio goes up. There's no hidden second revenue stream quietly pulling their recommendations in a direction that doesn't serve you. Tony Robbins is not subtle about this. He's seen too many everyday people get quietly fleeced by a system they trusted completely. Not always through malice, sometimes just through misaligned incentives that nobody ever disclosed properly. The road to financial mediocrity is absolutely paved with advisors who meant well but were being paid to mean it slightly differently. The questions you need to ask before trusting anyone with your money are simple. Are you a fiduciary always? Not just sometimes. How exactly do you get paid? Do you earn commissions from any products you recommend? What conflicts of interest do you have? If those questions make someone uncomfortable, that discomfort is information. Real trust in financial advising isn't built on credentials and confidence alone. It's built on transparency, on aligned incentives, on an advisor whose success is genuinely, structurally tied to yours. That relationship exists. Those advisors exist. But you have to look for them specifically. Because in a system designed to profit from your trust, the people worth trusting are rarely the ones most aggressively asking for it. Chapter 8. 9 Steps to Financial Freedom. Let's be honest about something. Most financial advice lives in the abstract. Invest early. Spend less than you earn. Diversify. Build wealth. Great. Fantastic. Incredibly helpful. About as actionable as telling someone who's never cooked a meal in their life to just make good food. Thanks. Very illuminating. What people actually need isn't more principles. They've got principles. They've heard the principles. The principles are not the problem. The problem is the road, the actual step-by-step, what do I do on Monday morning road from where they are right now to where they actually want to be. And that's exactly what Tony Robbins builds here. Not a vague motivational framework, a map with actual landmarks. Let's walk it together. Step 1. Make the most important financial decision of your life, and that decision isn't which stock to buy or which fund to pick. It's deciding what percentage of your income you will save and invest automatically, before you spend anything else, before the rent, before the groceries, before the subscriptions you forgot you signed up for and definitely aren't using but haven't canceled because that requires 2 minutes of effort, and somehow that feels like too much. Pay yourself first, automatically. Non-negotiably, even if it starts at 10%, even if it starts at 5%. The number matters less than the habit. The habit is everything. Step 2. Become an insider. Know the rules of the game you're playing. We've covered a lot of this already: the fees, the fiduciary standard, the allocation strategies. This step is about committing to financial literacy not as a one-time event, but as an ongoing practice. The game changes. Tax laws change. Products change. The investor who keeps learning keeps winning. The one who learned everything they know from a coworker in 2011 and never updated it, that person is flying blind with great confidence. Step 3. Make the game winnable. Here's a step most people completely skip. They have a vague idea that they want to retire comfortably someday, which is about as specific as wanting to be happy. Define the number. Actually sit down and calculate what financial freedom looks like for you specifically, not for a magazine cover, not for your neighbor, for you. How much does your life cost per year? How much would you need invested to generate that income passively? Now you have a target. Now the game has a finish line. You can't win a race you haven't mapped. Step 4. Make the most important investment decision of your life. And here we're back to asset allocation, because Robbins returns to it here deliberately. It's the decision that matters more than any individual investment. Get the allocation right for your age, your risk tolerance, your timeline. Then commit to rebalancing it regularly so it doesn't drift away from your intention as markets move. Step 5. Create a lifetime income plan. This is the step where you think beyond the accumulation phase, beyond just building the pile, and start thinking about how you turn that pile into income you can never outlive. Annuities, dividend strategies, systematic withdrawal plans that account for longevity risk. The goal isn't just to have money, the goal is to have money that keeps showing up every month for as long as you need it to. Step 6. Invest like the ultra-wealthy. We've covered the Dalio all-weather approach. We've talked about alternative assets. This step is the commitment to actually implementing those principles rather than just admiring them from a distance. It's one thing to understand how billionaires build portfolios. It's another thing to actually restructure your own with that same logic guiding you. Step 7. Just do it, enjoy it, and share it. Which sounds like a Nike commercial, wrote the chapter title. But the substance underneath it is genuinely important. Robbins is pointing at something psychological here. The people who sustain long-term financial discipline aren't the ones grinding through it joylessly. They're the ones who connect their financial behavior to a larger purpose, to family, to freedom, to generosity, to something bigger than the number in an account. Purpose sustains discipline in a way that willpower simply cannot. Step 8, and this is the one that quietly hits different when you really sit with it, is to tithe and give. Robbins talks about this seriously, not as a religious obligation, but as a psychological and practical pattern he has observed consistently among the financially successful. Generosity, giving a portion of what you have before you feel like you have enough to give, creates a mindset of abundance that actually accelerates wealth building. It sounds counterintuitive. It works anyway. The math is strange, but the pattern is real. Step 9. Live it, which means stop waiting. Stop waiting until you earn more, until the market settles, until you feel more ready, until life gets less complicated. Life does not get less complicated. That train does not arrive. The people who start imperfectly today consistently outperform the people waiting for a perfect moment that never comes. 9 steps. Not 9 days. Not 9 months necessarily. This is a journey that unfolds over years, over decades, but every single step is available to you right now, today, with whatever you have, wherever you are. The road to financial freedom doesn't start when you have enough money. It starts when you decide you're finally done not having it. That decision? Only you can make it. And the best time to make it was 10 years ago. The second best time is right now. Chapter 9. Risk equals foolishness or opportunity. March 2009. The stock market had just finished its worst 18 months since the Great Depression. The S&P 500 had lost nearly 60% of its value. Retirement accounts looked like they'd been through a paper shredder. People who were supposed to retire that year were quietly calling their old bosses and asking if their desk was still available. The financial news was apocalyptic. Every headline was basically a different creative way of saying everything is terrible and possibly getting worse. And right there, right in that exact moment of maximum fear and minimum hope, the greatest buying opportunity in a generation was sitting on the table. Most people ran away from it. A handful of people walked toward it. Those two groups have had very different decades since. That's the story of risk in one paragraph. And it's the story Tony Robbins wants you to actually understand, not just intellectually agree with, but feel in your bones. Because the gap between understanding risk and responding to it correctly in real time is where most investors permanently damage their financial futures. Risk is not what you think it is. Most people define risk as the possibility of losing money. And yes, technically, that's accurate. But it's incomplete in a way that leads to consistently terrible decisions. Because if losing money is the only risk on your radar, you will do anything to avoid it in the short term. including avoiding the very investments that would grow your wealth in the long term. You'll sit in cash. You'll wait for certainty. You'll wait for the all-clear signal that never actually comes, because the market doesn't send all-clear signals. It sends confusing mixed signals and then moves violently in whichever direction you least expect it. The risk most people never account for is the risk of doing nothing, the risk of being too safe. Inflation running at 4% while your money sits in a savings account earning 1% is not safe. That's a guaranteed slow loss dressed up in conservative clothing. You feel safe. You are losing purchasing power every single year. The danger is invisible, which somehow makes people less afraid of it, even though invisible dangers are exactly the ones that kill you. Here's another way risk actually shows up that most people never see coming. Emotional risk. The risk that you yourself, with your very human, very irrational, wonderfully predictable emotional responses, will be your own worst financial enemy at the exact worst possible moment. The research on this is genuinely humbling. Studies consistently show that the average investor earns significantly less than the average fund they invest in. How is that mathematically possible? Because of timing, because people buy after markets have already gone up, chasing performance, and sell after markets have already gone down, fleeing pain. They buy high and sell low, over and over again, not because they're stupid, because they're human, because fear and greed are not abstract concepts. They are physical experiences that override logic in real time. Dalbar, a financial research firm, has tracked this for decades. The gap between what markets return and what average investors actually capture is staggering. We are consistently, predictably, our own worst investment. So what's the antidote? First, reframe what volatility actually means. Volatility is not risk if you have time. A market that drops 30% and then recovers and goes higher is not a disaster for a 35-year-old with 30 years of runway. It's a sale, an actual, legitimate, everything is cheaper sale on ownership stakes in the best companies in the world. The problem is, it feels nothing like a sale. It feels like catastrophe. And so people behave like it's catastrophe. They sell, and then miss the recovery entirely. Second, build a portfolio you can emotionally survive. This sounds soft. It is not soft. If your allocation keeps you up at night during corrections, if you're checking your portfolio 17 times a day when markets are volatile, your allocation is wrong for you psychologically, regardless of what any spreadsheet says is optimal. An allocation you can actually hold through turbulence is infinitely better than a theoretically superior allocation you'll panic sell at the bottom. Third, automate your behavior. Dollar cost averaging. Investing a fixed amount at regular intervals, regardless of market conditions, removes the emotional timing decision entirely. You buy when markets are up. You buy when markets are down. You buy more shares when prices are lower automatically. Over time, this mechanical consistency outperforms the vast majority of people trying to time things perfectly. Because perfect timing is a myth, consistent behavior is not. Tony Robbins makes a point here that lands quietly but hits hard when you really absorb it. The investors who built the most wealth over the last century weren't the ones who avoided every downturn. They were the ones who stayed invested through every downturn, who treated crashes as noise rather than signal, who understood that the market's long-term direction has always been up, and that the temporary discomfort of volatility is simply the price of admission for the extraordinary long-term returns that patient investors collect. Risk isn't foolishness. Running from it blindly, that's foolishness. Understanding it, managing it, and using it deliberately, that's opportunity. The market will crash again. Guaranteed. We don't know when, we don't know how deep, we don't know what will cause it, but we know with absolute certainty that when it happens, two types of investors will exist: the ones who panic and the ones who were ready. Decide now which one you want to be, because when the moment arrives, and it always arrives. There won't be time to decide. Chapter 10. The Billionaire's Playbook. We've come a long way together. Think about where this conversation started. Fees quietly eating your retirement alive, a pension system that evaporated, a social security safety net full of holes, an industry built to profit from your confusion. And somewhere underneath all of that, a quiet, persistent, deeply human question that's been running through every single chapter of this book. Is it actually possible for a regular person, not a trust fund kid, not a Wall Street insider, not someone who got lucky on a startup, but an actual, normal, paycheck-to-paycheck, student loan carrying, trying to figure it out American, to genuinely win this financial game? That's the question we started with. Here's your answer. Yes, but not by playing the game the way most people play it. Tony Robbins spent years sitting across from the greatest financial minds alive. Ray Dalio, Warren Buffett, Carl Icahn, Paul Tudor Jones, John Bogle, Mary Callahan Erdos, people who collectively manage trillions, actual trillions, of dollars. And he asked them all essentially the same question. What do you know that most people don't? What would you tell a regular person trying to build real wealth from scratch? And the answers, across all these different personalities, different philosophies, different investing styles, converged on a surprisingly consistent set of truths. Not secrets, truths, available to anyone willing to actually listen. Here's what the billionaires said. Ray Dalio said, "Don't think you're smarter than the market. Build a portfolio designed to survive environments you can't predict rather than trying to predict them." His all-weather philosophy isn't just a portfolio strategy, it's a philosophy of humility, of accepting that the future is unknowable and building accordingly. The arrogance of prediction is one of the most expensive habits an investor can have. Dalio built his entire system around eliminating it. Warren Buffett said, "The simplest advice is almost always the best advice." Buy low-cost index funds, hold them forever. Stop watching the news. Stop listening to predictions. Stop doing anything clever. The investors who've done best with Berkshire Hathaway stock over the decades aren't the sophisticated traders who moved in and out strategically. They're the ones who bought it, put the certificate in a drawer, and forgot about it for 20 years. Boredom in investing is a feature, not a bug. Buffett also said something that cuts to the bone if you let it. The stock market is a device for transferring money from the impatient to the patient. Read that again slowly. Every time you panic sell, every time you chase a hot trend, every time you try to be clever, you are the impatient. And somewhere on the other side of that transaction is a very patient, very wealthy person saying thank you sincerely. Paul Tudor Jones said, "Always protect the downside first." We talked about asymmetric risk. Jones lives it. He won't enter a position without knowing exactly what he's risking and having a strict limit on how much he'll lose before he exits. He doesn't let hope become a strategy. He doesn't average down on bad bets hoping they'll recover. He cuts losses quickly and lets winners run. Discipline over hope, every single time. Carl Icahn said, "Do your homework. Don't outsource your financial thinking entirely to someone else. Don't blindly trust. Don't assume. Ask questions. Understand what you own and why you own it." Icahn built his entire career on understanding things more deeply than the people on the other side of his trades. You don't need his level of obsession, but you need enough understanding of your own financial picture that you're not completely dependent on someone else's honesty and competence. John Bogle, the man who literally invented the index fund and arguably did more for the average American investor than any single person in history, said something beautifully simple before he passed. In investing, you get what you don't pay for. Costs are certain, returns are not. So minimize what's certain and let the uncertain side take care of itself over time. Low costs, broad diversification, long time horizon. That's the whole thing. Decades of Wall Street complexity, dismantled into 3 principles by a man who understood the game better than almost anyone. And here's the thread that runs through all of them. Every single one of these people, despite their wildly different personalities and strategies, shared one foundational belief: that the biggest enemy of long-term wealth is not the market, not inflation, not even taxes. It's you, your fear, your impatience, your need to feel like you're doing something clever, your susceptibility to narratives, your inability to sit still when everything feels uncertain. The most sophisticated financial architecture in the world collapses if the person managing it can't manage themselves. This is why Robbins spends so much of this book not just on strategy, but on psychology, on identity, on becoming the kind of person who makes calm, long-term, principle-driven financial decisions even when everything around them is screaming to do the opposite. Because that person, the calm one, the patient one, the one who learned the rules and then actually followed them, that person doesn't just build wealth, they keep it. They grow it across decades, they pass it forward. And somewhere along the way, without really meaning to, they become the person in someone else's life who finally told them the truth about money before it was too late. Maybe that's you now. Maybe that's exactly what this was for. The game was never really about the money. It was always about the freedom on the other side of it. And that, finally, is yours to go build.